Ladies and gentlemen, please welcome Eric Balchunas, Senior ETF Analyst for Bloomberg Intelligence, where he writes research for the Bloomberg Terminal. He also helped create and appears on the first ever ETF TV show called Bloomberg ETF IQ, as well as a podcast called Trillions. Mr. Balchunas is also a Bloomberg opinion contributor and author of the Institutional ETF Toolbox, which was published by Wiley in March 2016. He holds a bachelor's degree in journalism and environmental economics from Rutgers University. Please welcome James Seyffart as an analyst covering ETFs and the broader fund industry, and to a lesser extent, crypto assets. In this role, he writes research for Bloomberg Intelligence and assists in the production of Bloomberg ETF IQ, the only TV show fully devoted to all things ETFs. Before becoming an analyst with Bloomberg Intelligence, Mr. Seyffart spent the early parts of his career working in Bloomberg's data department. Eric and James, thank you so much for being here today.
Thanks for having us.
All right, the stage is yours.
All right. Well, thank you very much. We're going to get right into it because we want to get through as many ETFs as possible. That's why James put 10 plus. 10 is our minimum, but we hope we can get into more. I've done the Money Show many times, and over the years, I find that people really enjoy learning and meeting and understanding the ETFs themselves rather than, say, the bigger, broader trends in the asset management industry. So we just have tickers galore here. But these aren't necessarily ETFs that we're saying buy or sell. We really can't or don't do that. These are ETFs we keep thinking about. They're ones on our radar that tap into bigger themes. And this is, I think, a good way to tap into those themes is through some of these actual specific products. So that's generally what we're going to go over today. James is controlling the slides, so I'm going to have to say next to him a couple times, but only one of us could control the slide. So I'll start off, and then James and I are going to sort of tag team the whole way, and we'll see how far we get. So 2021 so far. Before we get into specific ETFs, let me just set the stage for what's going on this year. This is a list of all the ETFs by their year-to-date flows. So this would be like looking at the bestseller list. So you can see here, there's a lot of vanilla ETFs, VOO, which is S&P 500, VTI, it's total market, IVV, another S&P 500, BND is total bond. VTV is unique. Value is making a comeback this year. IEMG, emerging markets, are making a comeback. You probably, I don't think you see a small cap on there, but small caps are having a decent year. XLF financials are having some of it a comeback. And then you've got ARK, which is sort of still in there from last year. It had a great year. RSP is equal weighted S&P 500. So this year has been really marked by the bench players scoring. So you've had the typical ETFs that always get money that lean towards the, say, beta and tech. But now you're also having these other ones that were sort of not doing well the past couple of years, finally seeing some action. And that would be small caps, value, emerging markets. Whether that lasts remains to be seen. The past couple of weeks, there's been a shift back to that sort of growth in tech trade. But regardless, this is how it's going. Now, the 10 ETFs we're going to go over, some are vanilla and some are what we would call hot sauce. And this is also another trend in the flows. We see a lot of money going to sort of cheap, dirt cheap vanilla, the stuff that would make the core of your portfolio, the sort of boring Vanguard stuff. And then the rest of the flows go to stuff that would be completely opposite, stuff that you would add on top of that is very different than the vanilla. And so we call this barbelling. And so a lot of the ETFs we go over today will probably be on one side of that barbell because that's where a lot of the flows are going and that's how portfolios are shifting. So we wanted to stick there. All right, so I'll kick off with the first one. James, if you want to go forward. No shocker, ARK. This is one that we constantly talk about, think about, write about. Took the ETF world by storm. This is managed by Cathie Wood. This ETF had no business being successful. It's high cost. It's a stock picker. It's really out of vogue right now. And it is an independent issuer, not great distribution like, say, a BlackRock. And yet it's massive. It's taken in all this money. I think ARK is about 50 billion last I checked. This is up from a couple billion only 2 years ago, 3 years ago. So that to say, it's not an overnight success story. This fund was around for 5 years, living in oblivion, performing well. But it wasn't until March 2020 when the sort of market rebound happened that ARK really took off. It was perfectly positioned to play this sort of work from home trade, this lockdown trade, which really favored some of these sort of tech stocks and digital companies that ARK invests in. So ARK has a whole suite of ETFs, and we continue to watch them. This year has been rougher on ARK because of the rebound in value and small caps and some of the stocks that they are not in. That said, some of the critiques on ARK tend to trace it from their all-time highs. And, so, if something's up, say, 150% over the past 12 months and then has a 30% drawdown, it's still up a lot. So our point with ARK is that this fund has been completely transparent with what it said it's going to do. It's going to invest in a concentrated portfolio of names that they think are going to have change the world, basically, and disrupt their industries. They're looking 5 years into the future. That means volatility. So I think this is one of those funds that you need a stomach for. But over the drawdown, there wasn't a lot of outflows. And we think this is largely because of the people buying into Cathie Wood's strategy. And also, we don't think this is their main investment. They think this is the hot sauce they add on top. And because it's not their main core allocation, they probably have more of a stomach for that drawdown. So that's what we're watching right now when it comes to ARK. I'll pass it to James for the next one.
Yeah, so as Eric mentioned, I think if you're going to be expecting those multi-100% returns, you got to be able to stomach a little volatility, and it seems that the investors have. For my first one, I'm going to go over, I'm cheating a bit because I'm going to go over GBTC, this Grayscale Bitcoin Trust, which is not an ETF, but it's something that I cover heavily. I feel like it's the number one ticker that I end up talking to clients about because they have so many questions. But the Grayscale Bitcoin Trust, it acts more like a closed-end fund, so it has a limited number of shares. This creation redemption opportunity that ETFs have that allow the price of the ETF or the fund to trade in line with the underlying holdings is a key factor in ETFs that's not here in GBTC. The SEC is not allowing an ETF, but that hasn't stopped investors from going and finding this thing, trading OTC in the markets and just piling money into it. I mean, this thing at its peak had over $40 billion in assets. We saw in 2020, there were no real ETFs in North America. So we looked at these closed-end funds that were in Canada, and they were just taking in billions and billions of dollars. You can see those flows. GBTC is dominating in the blue. But now there's ETFs in Canada, and that has been a bad spell for GBTC. Now, Bitcoin, obviously, as most of you know, has had a rough 2021 since February, roughly. So what happened with GBTC, it has these wild swings where it'll trade, the price will be way more than the underlying Bitcoin it holds. But right now it's trading way lower than the underlying Bitcoin it holds. So you basically have the shot to buy Bitcoin at a discount, but who knows where that discount or premium is going to go. It could get steeper. It could go back into a premium. No one knows. So this is like a really volatile asset, volatile way to play Bitcoin, but there's not many other options right now on US securities exchanges. So and part of the reason for this huge discount is just have to point this out. The way this works, I talked about, there's a limited number of shares. This thing, when you enter this fund, you have to be an accredited investor, but you can buy it on those shares on the OTC market or on the secondary exchange. And what happens is the people, once you enter, you have a lockup period. So you can't sell those shares for 6 months at a time. So what we're watching right now is when those shares are locking up. We're currently in that level you can see right where I have that purple arrow where there's a flat line. So basically GBTC was closed for like a month. So there was no new creations. But what ends up happening is when they open 6 months ago, there's a flood of shares that get released to the market. So there's constant selling pressure of these new shares hitting the market. It's almost like new share issuance. So it's not good for the price or the discount of GBTC. So that's something we're going to be watching going forward. And it looks like it hasn't been open for quite a while. So here we are. This is the current state of the Bitcoin ETF race. We have a ton of them. We just had ARK, what Eric was just speaking about. ARK just filed in partnership with 21 shares, an ETF issuer in Europe. So we're constantly watching, when are we going to see a Bitcoin ETF? Probably unlikely in 2021, but we think 2022 is definitely still on the table, but we're watching everything that Gary Gensler and the SEC is saying to see when we're going to see a Bitcoin ETF on US ETF exchanges. I'll pass this off to Eric.
Yeah, and just to reiterate what James said, GBTC has that, we call it the third element. With an ETF, the price is always going to be close to the NAV, and people like that. It's like buying a car right at the Kelley Blue Book value. That's why, and that's because arbitrage is people can arbitrage the price with the underlying securities. You can't do that with GBTC. So you have this third element of limited shares. That's the main thing, but it's the one of the options. I was at a money show in Florida a couple weeks ago, and somebody asked about the Canadian Bitcoin ETFs. And if you can get to a Canadian exchange or a broker, BTCC is the biggest one up there, and that does a great job. That has very good tracking. And so if you can get there, BTCC, I think is a good option. But yeah, I wouldn't look for a Bitcoin ETF probably till next year. It's unfortunate. We think they should just have approved it already, but I'll get off my soapbox. If you have any questions, by the way, just ask them right now, and they'll put them in, and we'll take them live as they come in, just like as I would do if this were a live presentation. Okay, next. I have a double header here, but they're related. FPX, the IPO ETF. Now, IPOs have a bad name. I don't know. I guess because of the dogs that come out and flop, or people buy high, sell low. There's a lot of negativity around IPOs. But this ETF has basically doubled the S&P 500 since it came out in 2006. That's through a correction. That's through a lot of market spasms and ups and downs. It's really a fascinating story. And all this ETF does is take in a new IPO, hold it for about, I think it's 4 years, and let it go. We call it catch and release. The good news here, and what we like about ETFs, is we want to know, are you adding any value? And most IPOs come out and they don't get into the big indexes till they're, we call them like teenagers. This one tracks them when they're toddlers before they get into the mainstream indexes. And so it's serving up an area of the market that almost nobody has exposure to. And the reason that it outperforms isn't because all IPOs do well. It's that you only need like 4 or 5 blockbuster, out of their mind IPOs, like a Tesla and Facebook, to completely offset the dogs that come out that get a lot of bad press. So we are constantly fascinated by this IPO catch and release ETF out there. Now, related, we all know about SPACs. So SPCX is one we watch. There's a couple SPAC ETFs, but this is the only one that tracks the SPACs before they announce their merger. In other words, this is pre-IPO SPACs. There's a bunch of them out there. Their performance kind of is shaky, but then if they announce a merger, they pop. And so this, you're basically like betting on a bunch of horses for ones that will pop. And this is, to me, again, serving up all the legwork of doing that. Who in the heck knows which SPAC is going to have a merger? Nobody does. If you do, that's illegal. You can't know that information. So we like some of these ETFs that go out and just basically serve a bunch of them up in the hopes that 1 or 2 or 3 will have that pop and lift the performance of the whole fund. The other SPAC ETFs sometimes will hold them after the IPO when the performance is it could go up or down, but it doesn't have that pop that you get from the announcement. So SPCX has just blown past the other ones because of this feature that it only owns the pre-IPO SPACs. And so if you FPX and SPCX to me are kind of sister ETFs, serving up areas of the market that really just aren't in any other big indexes. I'll pass it back to James.
So the one I'm going to talk about is iBuy from Amplify. Now, I don't need to go in and explain the investment thesis behind an online retail ETF, but as Eric talked about with FPX and SPCX, the difference is like Amazon dominates any broad index you're going to invest in, right? So if you're investing in online retail, your probably first thought is like, oh, I'll just buy Amazon. And we like this one because it's different. It's multi-factor, so it uses a bunch of different things, but it's really equal weighted. And what it does is invest in the global US market. I mean, the global market, but it puts like 75% of the funds in the US and US based companies and equal weights that basket. So everything gets the same weight in that basket, and it does the same thing with the other basket, which is the global side of things. So what it does is you get a whole global exposure, and you're not investing in just these dominant online retailers. So you recognize these names. I'm sure you recognize a lot of them, but you can see their percentage weights, nothing is over 4%. Whereas if you really did an online retail ETF, and you weighted by market cap, you basically have Amazon way at the top and all the big names you've heard of. And this just gives you a much broader exposure, because as Eric said, who wants to invest in a thematic ETF or a certain ETF that you're putting on like a satellite portion of your portfolio that you already have in your S&P 500? So we like this. This fund is doing exceptionally well as far as asset gathering goes. And obviously it's something we're going to continue to be watching going forward. And I'll give it to Eric for our next one.
Okay, so we just went over a couple, hot saucy ones. Let's go to the most vanilla ETF there is. And in my opinion, the closest thing to a flawless, perfect ETF, and it's VTI. VTI is the Vanguard Total Stock Market ETF. It's a monster. It's 217 billion, but it's a share class of the bigger Vanguard Total Market Mutual Fund, which collectively have well over $1 trillion. So that's the first collective $1 trillion fund ever to exist. And you see the 3 basis points there of the fee, the lower right-hand corner. That's obviously very cheap. But because a couple things about this ETF. When you saw the S&P 500 add Tesla on the late side, I mean, it was basically Tesla's been around for 10 years, and S&P 500 just added it. So here's VTI's, go back one, James. Here's VTI's holdings. It's had Tesla in there since 2010. And so as Dan Egan of Betterment coined this phrase, it's FOMO proof. You never have to wonder if you hold something. Whereas with the S&P 500, you don't know if you hold it. Do I own GameStop? Do I own Tesla? I don't know. The S&P 500 is simply large cap stocks, and there's a committee that decides essentially what goes in and out. And there's other criteria. It's in a way, it's kind of like a smart beta fund with a human oversight. That said, it's close to beta. It's close to being vanilla, and it's fine. Even Jack Bogle of Vanguard was saying the difference is minimal. That said, Bogle over the years tended to favor VTI and the total market over the S&P 500. And because the S&P 500 had this sort of debacle adding Tesla late, next slide, James, you can see here that other basically large cap vanilla ETFs beat the S&P 500 last year by a good amount because they added Tesla so late. VTI, again, this idea that you don't have to worry about it, we think is powerful. And because the 3 S&P 500 ETFs are sort of fighting over this sort of these flows, VTI is kind of peerless. It doesn't really have any major competition as the total market. And thus, I think VTI will be the largest ETF in about 5 years and will be the first and only ETF to ever unseat SPY as the largest. And it will remain the largest for decades. That is my opinion. But again, we think VTI is great. And the last thing I will say is because VTI holds some small cap stocks in there, remember it's total market, those have the manager of VTI can lend out some of those to hedge funds, and they can get a decent fee for those that they put back in the NAV. So the tracking of VTI is basically perfect. And so you almost don't have to pay the 3 bips. You make them up in perfect tracking. And so in a way, you're getting the whole market for free. And this to me is also arguably the first free ETF or one of them. So anyway, that's one we keep watching. And again, I think it's going to be the biggest ETF. I'll pass to James.
Yeah, fun fact. Actually, GLD did unseat SPY for a couple of days way back when, but
that's right.
SPY
for one day
came back. Yeah.
Yeah, it was one day. It was like August 2011. You're right.
Like that.
Fair point. Yeah. Okay.
Yeah. So the next one I want to talk about is the AdvisorShares Pure US Cannabis ETF. Much like the last one, I don't need to talk to you about the investment thesis behind cannabis stocks or marijuana stocks, whatever you want to call it. This one, there's a whole slew of them. The first one was what's known as MJ, and basically what ends up happening with a lot of the cannabis ETFs, there's certain stocks they can't hold. They're known as multi-state operators or MSOs. And this ETF is the first one to get exposure to them, but it went in about a unique way. So essentially, it's illegal to hold these stocks, or there's a lot of like legality gray area of holding these multi-state operators because technically marijuana is still federally legal. So companies that operate across state lines are technically illegal. So they're not allowed to hold them per se. So what we have here is a way to get this exposure. And the way they did it is they basically took swaps out. So they don't actually hold the physical equity securities in the ETF. The fund is technically actively managed, but to get exposure to those multi-state operators, which are arguably going to be the biggest beneficiaries as more and more states legalize, and eventually if the federal government ever legalizes. So that's why this was created, basically to provide that exposure. And here I'm just showing you what MJ, which is the largest marijuana ETF, is available in the US is. You can see it's 58%, 60% Canada, right? So what you end up doing is you're investing heavily in Canadian marijuana stocks when you buy a lot of these normal cannabis ETFs. So you got to look under the hood to really understand what you're investing in. And the other thing to note is, like, if you're investing in this and the US is legalizing, honestly, the Canadian companies might end up getting hurt potentially, or at least won't be as beneficial to them as the US company. So there's all these things going on. We're obviously watching this and we're seeing how this plays out. This is another hot thematic sector ETF that we'll be paying attention to. I'll give it back to Eric for another boring one, in my opinion.
Yeah, so I just went over boring on the equity side, VTI. Here would, to me, is a great compliment to it's sort of like the VTI of bonds. It covers more of the bond market than the AGG or BND, which track the Bloomberg Barclays Aggregate Bond Index. And the reason we watch IUSB, which by the way is on the top 10 flows this year, I think people are really starting to notice this. It's making it into BlackRock's own models. The big deal here is, first of all, look at the fee. It's 6 basis points, so it's dirt cheap, almost as cheap as the aggregate bond ETFs. James, can you go to the next slide?
Yep.
So check out the breakdown here. You're going to get corporate bonds, mortgages, government. U.S. is 83%, so you get a little bit of international in there too. And look at the composite rating. You see the double B and the B? That's going to be a little bit of high yield. So you get a little spice in there. The reason that the international and high yield are important is because most fixed income active managers, which still tend to see decent flows because they benchmark against the ag and they beat the ag consistently because they pull the lever of adding a little high yield and a little international. If you compare fixed income managers that are benchmarked against the ag to this ETF, which holds a little fixed income, a little high yield and a little international, their outperformance rate gets cut in half. It's a fair benchmark for them. And thus, I think it's a great overall holding. And I'm not surprised to see this rising up and taking in more money than AGG this year. This is from this chart's a little old. If I put the new one in, the flows explode. So this year, this is one to watch. We think this could actually be bigger than AGG one day. Next, I'll pass it to you.
Yeah, and I would add, like the IUSB, like when you compare against that benchmark, like Eric said, it does get cut in half. But even still, fixed income managers still manage to beat their benchmark, no matter how good the benchmark is, more than equity active managers do. So that's still something that's just like basically a proven truth in asset management at this point. So the one I want to talk about is the Invesco NASDAQ Next Gen 100. This is basically, they just launched this in October of 2020. And all it is you know what the NASDAQ 100 is. It's X Financials. It's listed on the NASDAQ. But what this is the next 100. So it's basically, you have the first 100 on the regular ones. People probably know it as the Qs. And then this is the next 100 ones that are going to go into the queue. So they're next up in line to be there. So these are like, you get a little smaller cap tilt, mid cap tilt away from the large cap QQQs. And this is done pretty well. We're at almost, they're getting a bunch of assets. It's cheap. It's only 15 basis points. And it gives you a little bit more spice than just the regular Qs. So when you look at this, everyone has loved the Qs. The last few years, the Qs have absolutely dominated SPY. You're looking at a 260% outperformance since 2011. So these numbers are just, this is something a lot of you probably realize. So there's a second one I want to throw in here, which is the Invesco NASDAQ 100 ETF, QQQM. And basically, this is just a mini Qs. So the Qs, if you invest in QQQ, it charges 20 basis points. And this is just a mini version. It's the same exact thing. It holds the same portfolio, except it charges 15 basis points. So for a retail investor, it might not make that 5 basis points, might not make a big difference. There might be some tax considerations to consider. But if you're an institution, you're holding these products for a long time, 5 basis points can really make a big difference. And that's why this thing's already over $1 billion, despite launching the same day as QQQJ. So this is something also we're watching to see how long, if ever, maybe this thing will take over assets versus the Qs themselves. And I'll give this one back to Eric for one of his favorite ETFs to talk about.
Yeah, so someone had just asked a question. A lot of these ETFs are at all-time highs. What are ones that aren't at the top? And URNM, I think, would qualify, even though it's been on a great run recently. This is uranium miners. If you go back 10 years, though, this group of stocks is down 66%. That said, it's popped about 150% in the past year. And I like to think about uranium as obviously fueling nuclear energy, and nuclear energy to me is sort of like green investing for realists. I think solar and wind get all the attention, and ESG and all that, and people don't want to think about nuclear, but all that stuff can't get us to where we need to go if everybody wants to keep their lifestyles. And so Bill Gates wrote a blog post in 2008 saying nuclear is ideal for climate change because it's the only carbon-free, scalable energy source that's available 24/7. So given the awful 10 years it had room to pop, and this sort of growing potentially political support for it over the next decade is powerful. And so we've been watching it, and I got to be fair, we were on this before it popped. But that's one that's not near its all-time highs. This one's been beaten up for a decade. It's starting to come to life, and that would be URNM. So I'll just leave it there with that one and go back to James because we have one or two questions to get to.
Yeah, and then I would also add, you said not near all-time highs. There's a plenty of ETFs out there to play like hedging yourself. So there's the new buffer products out there that'll hedge you against a certain percent of downside losses. There's a new ETF issuer Simplified that uses options to basically play convexity so that if it goes down too fast or goes up too high, you'll end up hedging a little bit. So there's a whole bunch of ETFs out there that are built to basically for people concerned about the market being at all-time highs.
Yeah, and let me just jump in real quick on this. There's also deep value ETFs. I mean, that area has been, it had a good 6 months, 5 months this year, but like Deep is one, QVAL, FOVL, the deep value ones, and also what's QVAL's international? I think it's IVAL. But anyway, international deep value is probably the lowest of the low. And there's also small cap value, like an IWN. Those have really, really been beat up. But they have come to life this year, except the last 3 weeks, it turned back around and growth and tech are back on top. So who knows? We don't know, but certainly deep value might be a place to go if you're looking for something that's not anywhere near all-time highs.
Yeah, small cap value has been one of the worst places to be for the last 6 years, despite all that academics loving it in academic papers. So the last one, the number 10, since we're running out of time, probably will be our last one. This is what probably my favorite ETF launch of the year thus far. So this is Engine Number One. If you recognize the name, it might be that they just won a huge activist lawsuit or proxy vote against ExxonMobil. And basically they got a couple people on the board where they want Exxon to kind of go away from fossil fuels. And they're doing this, they're basically ESG activists. And they just launched this ETF. And I love it for a few reasons. One, instead of just going after it, it honestly makes a little more sense intuitively. So most ESG ETFs, there's like a spectrum, right? Like you're either investing in companies that are really good for ESG and have high scores and you're going after them, or you're looking at an index and you're taking away just the worst actors, right? So you're taking out the companies that are worst actors from a given sector, which I tend to like a little bit more. But again, what's that doing for ESG? You're just excluding a few different companies because they have some bad scores and some ESG metric. This just makes a little more intuitive sense. You're going to hold the largest 500 stocks. And as a company, Engine Number One is going to do the best they can to go after an activist in an activist strategy to change the way they're doing things for ESG principles. So if you really are about ESG principles and this makes sense. The other thing is it's only 5 basis points and is holding the largest 500 stocks. You're not going to underperform the benchmark. You're not going to do anything out of the ordinary. So that makes a lot of sense. And also, we just love the ticker. VOTE is such a good ticker. There is a ticker premium if you can invest in a good ticker. It's been proven time and time again that it can help you gain assets. So we're pretty bullish on this getting a lot of assets going forward. We just think it makes better sense. It's easier to sell. And the other thing to point out is they have a lot of experience here from different areas. So they have hedge funds included, and their connections could be key because the reason they won that vote with Exxon was because BlackRock and Vanguard, who have tons of voting power just from having all those assets, have exposure to, basically they got them on board to go with them in the vote. And so one of the people on there is from BlackRock's iShares business. And this is just showing the fact that the watered down side of things tends to get most of the assets.
Yeah, that I think that slide's left over from it anyway. Okay, James. Oh yeah, perfect. This is where you can find us in the terminal. We also do a podcast called Trillions, which is available outside of the terminal. We're also on Twitter and LinkedIn, which again, we put out stuff for free there. But if you're on the terminal, this is where you can find our stuff and a bunch of cool data tools and whatnot. In 1 minute, I'm just going to attempt to answer a couple quick questions. What's our view on gold? I mean, who knows? That thing, they marched by the beat of their own drummer. I will say GLD now has a little brother called GLDM, does the same thing for half the cost. That's what I would point out there if you are looking for gold. IVOL, somebody asked about IVOL. That's Nancy Davis's fund. look, this fund has defied all the odds, kind of like Kathy Wood did. It's got a real low volatility level and decent returns. So it's got a nice sharp ratio. And it really is doing well. It's not the easiest thing to understand, but certainly, and it's got zero correlation. So it's a really interesting product. I'm actually surprised it succeeded because it's complex, but the numbers speak for themselves. What price do we see Bitcoin by the end of the year? Not touching that with a 10-foot pole. What is the best high yield dividend growth ETF? I don't know, high yield. I don't know, something like VYM or I don't know, James, you got one on that?
I would say if you're looking at a dividend ETF, I'd pay attention to exactly how it works. Some of them simply weight by dividend yield. So if you do that, you're just investing in stocks with prices going
What's
down.
one for the weighting by dividend yield? The VYM comes to mind for me. That's Vanguard's high dividend, or SPYD is another one. Now, one's for the growers. I think the one is what's the Schwab grower one?
DGROW.
Anyway, well, DGROW, and yeah, DGROW is pretty good. That's the Wisdom Tree US quality dividend growth.
DGRW, yeah.
And Aristocrat. What's the Aristocrat one? Noble, NOBL, is companies that have increased their dividend for 25 years.
Something crazy like that,
yeah. You won't get much yield in those, but they are definitely going to serve up really sturdy stocks if that's what you're looking for. We're at the time. Sorry to rush through the questions, but I just wanted to touch on them a little bit. And I thank you very much. Here's where you can find us again on Twitter and email. And thank you for your time today, and look forward to seeing you at the next one.
James, Eric, thank you so much. We appreciate you being here today. And ladies and gentlemen, thank you for attending. We hope to see you at the next session. Enjoy the rest of the show.